If breakouts were as simple as price breaks, price runs, every breakout trader will be profitable, but most breakouts fail and most traders get trapped at the move. Good morning and welcome to this particular episode whereby I'll be talking about why breakout traders get trapped. And basically, I'll be explaining this based on the concept of liquidity, because in the markets, liquidity is the fuel, liquidity is the king. Okay, so you have seen it before, I know. You have seen that price consolidates, resistance gets tested, and finally it breaks. So as a trader or breakout trader, you enter the trade, and within minutes you find that the price reverses. That's not bad luck, that's basically a liquidity. So this video is for traders who enter breakouts confidently, get stopped out constantly, feel like the markets wait for them to enter before reversing, or think brokers are hunting their stops. If breakouts feels like traps, this video will change how you see them. And here is the key insight that I'm going to give you, that breakouts don't fail randomly. They often succeed at one thing first. That is creating liquidity. And that is the purpose of breakouts. So once you understand that, you stop chasing and you start anticipating. So why breakouts attracts so many traders is because breakouts looks very logical, because we see resistant breaks and then we start buying, support breaks and then we start selling, momentum confirms that particular entry because of that momentum. So what this looks like, it feels very clean, it feels very obvious, and it feels safe. But remember, when you see these kind of instances, when it feels very obvious, very safe, very clean, then note that market don't reward obvious behavior. When a level is obvious, orders are stuck around that particular level. For instance, breakout buy stops, breakout sell stops, stop loss above highs, stop loss below lows. All these create a pool of liquidity, and liquidity is the fuel in the market. Okay, liquidity is the fuel in the market. So I'm going to share my screen so that you can see what I am talking about. So when you look at this kind of price action, okay, when you look at this piece of price action, so we can actually begin at this level. You see the price takes out liquidity. So at this level, there are a lot of orders that are stuck around this particular level. Okay, we have a lot of orders which are stuck around this level. Okay, so liquidities has been taken at this particular point, right? So let me actually, yes, let me mark it that way. So we see liquidities have been taken there, and then the market reverses. So for most of the retail, I mean the breakout traders, they will think that now we have a breakout. Okay, so what they'll be looking at is now looking at some buying opportunities, and they will get trapped, and the market now reverses and pushes all the way down. Okay, so as the market pushes all the way down, what it does also, it takes out these lows here. All right, it takes out these sell side liquidities, okay, for the New York session the previous day. So and the moment it does that, most of the retail traders will think that, or the breakout traders will think that this is the breakout happening, and they'll start positioning for sales. And what the market does is that now it starts reversing and pushes all the way up. Okay, so the reason why you have to understand this concept of liquidity, because it really matters a lot in the market. And what actually, or what liquidity actually means, all right, for you to be able to understand this, what liquidity actually means, you have to first of all simplify it. So I'll begin by simplifying to you. Liquidity, any moment or any time you hear liquidity, understand that's where orders are. So liquidity is equals to orders. So for large players to enter massive positions, they need someone on the other side. Remember, we said trading is a zero-sum game. So for there to be sellers, there has to be buyers. For there to be buyers, there have to be sellers. So for large players to enter massive positions, they need someone on the other side. And if institutions want to sell big, therefore, they will need buyers. So where are buyers? Above resistant, at breakout levels, in stop loss clusters. So price moves above resistant, not because it's bullish, but because it needs those buy orders to fill large sell positions. So like in this case, the price right, moves above this level, because you see this level is more of a resistant level. We can call it a resistant level. Even if you look at this particular point, this is more of a resistant level as well. So what happens is that what you're talking about is that the price moves up, not really because it's bullish, but it's moving up so that it can trap the buyers, and then the sell orders can be activated for the institution. The same case when the price is pushing here, not that because it is bearish, it is pushing down to take out these orders here, the sell orders, so that now it can be able to program for buys. That's how institutions think or program themselves in the market. Okay, so once that liquidity is collected, price can reverse, and that's the big trap. That's where traders get trapped. Okay, so you see, once the price takes out this liquidity, it reverses. Once the price takes out the Asian highs here, we see the price reversing. And like I'm saying, this is where now traders get trapped. The London liquidity is taken out, so traders think this is a breakout. They start looking for buys, and then that's where they get trapped, and the price pushes on the downside. Okay, so that's the trap that you need to avoid. So again, let's look at it in terms of the breakout trap mechanism. So here is how it usually unfolds, and especially if you're a breakout trader, please pay attention on this. So this is how the breakout trap mechanism happens. So you find that price consolidates. Okay, price consolidates, right? So let me show you that. So price, you find that the price consolidates, like in this case scenario here. We can talk about this case scenario here. You can say that the price here consolidated. Okay, so that is the entire of that is the consolidation. So it forms like equal highs or equal lows. So if you look at this level here, we have so many lows here lying together, some equal lows. So you can also see some equal lows around that particular point. Those are equal lows. And also you can see around this level, we have almost equal lows. So we have so many lows coupled there. Okay, so it also can form equal highs, right? So it also can form equal highs. So when you look at some instances like this one, you can see these are almost equal highs, because they are highs that are very close to each other, this high and this high. Okay, so then breakout traders start preparing themselves, and basically to enter the trade. So what happens is that stops accumulate above or below that level. So we will have, especially here when we have this high and this high, let me use this example, and this high too. So what this one looks like is a resistant level. Okay, so after this consolidation now, right, price pushes here. Also again, even around this level, we see price pushing here and testing this level thrice, 4 times. All right, so so after that price consolidation, then it forms equal highs or equal lows. Then breakouts traders start preparing themselves. So they'll think that now the price is breaking out and pushing on the upper direction. Okay, so then stops will start accumulating above the level, because that's where the stop losses will be. Then now what the price will do is that it will spike, right? It will give a spike above that level. So breakout traders enter, and stops are triggered, and then institution fill positions and price reverses. Like in this case, we have so many lows, almost equal lows here at this particular point. So what does the price do? So the price spikes. So the retail traders will start, or the breakout traders will start thinking that now we are out of this breakout session, because all this is breakout. So we are out of this breakout. So what it will do is that they will start now entering sell position. So their, I mean, sell position. So their stop losses will be hit, and then now the institution will activate their buy orders, and the price buys. Same case in this scenario. We have some equal highs resting around this particular point. You can see all these equal highs here. Okay, or these equal highs resting at that particular point. So so once these the price will spike on the upper direction, so creating like a false breakout, of course, because of the aspect of the liquidity. So now retail traders or breakout traders will start positioning themselves for buys. Then their stop losses are hit, and then now the market sells, the institutional sells. Okay, so remember, this is how it unfolds. I repeat again, 9 steps that you need to consider, or how 9 steps on how the breakout trap mechanism unfolds. Number one, price consolidates, then it forms equal highs or it forms equal lows. Then breakout traders start preparing, entering trades. Then stop accumulates above or below those equal highs and equal lows. Then number five, price will spike above or below those equal lows. Then breakout traders will enter the trades. Their stops will be triggered. Institutional will fill their positions, and price starts to reverse. So the breakout wasn't fake; it was functional. It served its purpose, and we said the purpose of the breakout is basically to engineer liquidity. So why most traders enter trades too early, especially the breakout traders, you find that they enter at the candle close, at the break, at the level of the break, or during emotional momentum. So, but what they ignore is the session timing, whether liquidity has already been cleared or whether displacement confirms continuation. So you have to look at all these things: session timing, whether liquidity has already been cleared, or whether displacement confirms a continuation. So what breakout traders mostly trade is the excitement, not structure, because they want to see that momentum, the price spiking up, breaking from a zone, and think that now the breakout has happened. And that's how they get caught up. So the problem isn't the breakout trading itself, it's trading without context. That's where the problem comes in. So how can you avoid breakout traps? If you're a breakout trader, here is how to shift, or here is how to have the shift. So you have to ask, you have to look at 4 things that I'm going to share. Number one, ask yourself, where are stops? So if stops are clearly stacked above a level, then you should expect a sweep fast before you start taking that trade. Okay, so you should expect a sweep fast. Then number two, wait for confirmation after the breakout. Right? Wait for confirmation after the breakout. Don't enter on the break. Okay? Don't enter at this particular point on the break. Wait for confirmation, right? So what are we waiting for this confirmation? You wait for pullback, right? You wait for pullback. Okay? Then you have to wait for structure confirmation and then continuation momentum. Okay, then continuation momentum. All right, that is very, very significant. That is very, very, very significant. All right, so number three, align with the session volumes. London and New York provide continuation moves, and avoid completely dead sessions which create fake pushes like the Asian session. All right, so you have to align yourself with the session volume. And number four, you have to understand the intent. Is the breakout clearing liquidity or building continuation structure? This kind of question will change everything. Right, so the 4 steps to avoid breakouts is: ask yourself where are stops, wait for confirmation after the break, and align with session volume, and finally understand the intent. Okay, you have to understand the intent of the market, right? So the reason why I'm sharing this is because I used to like chase a price every clean breakout I saw, thinking that the price is now breaking out, and now starting to align myself in that direction, only for me to be stopped out not once, not twice, but several times. But once I started asking myself, who benefits from this move? Where are the liquidities lying? Where are the orders or the stops likely to be clustered? Okay, so and once I start reasoning this kind of a direction, I started seeing good results in the market. I stopped getting trapped all the time. Okay, so and that shift alone was able to reduce for me what I call unnecessary losses. Not that it eliminated the losses completely, but those unnecessary losses were able to be reduced significantly. All right, so in summation, I have so many videos that I've done about liquidity, and as I'm doing even this one, I'm basically spicing up on those previous videos about liquidity. So you can just go and watch all of them, so that now you can be able to build on this particular concept. Okay, so breakouts, as I summarize, breakouts don't trap traders, but predictability is what does. Liquidity will drive prices, stops will create the fuel, and structure will reveal the intent. That should be always at the back of your medulla oblongata. Liquidity will drive prices, stops will create fuel, and structure will reveal the intent. So we have to stop chasing the move and start reading the motive. When you understand liquidity, then you stop feeling hunted. So that is very significant, and I believe you'll be able to apply these concepts so that you can be able to improve your trading. So in the next video, we'll be talking about trend trading mistakes that kill consistency, because even when traders understand breakouts and liquidities, they still struggle to align with the trend properly. So the reason why you shouldn't miss the next video. See you in the next one.